So let's talk about the basics of internal and external liquidity. As you can see, you have your swing high right here. Now price breaks that swing high and comes back and revisits that swing high. So what happened here? Your range will be that low that forced the break of structure, and the peak, which is the high that forced price coming back to revisit that break of structure. So now you have your range. So where would your external liquidity be? Your external liquidity is everything outside of the range. So you would have your liquidity right here and your liquidity right here. So now where would your internal liquidity be? Everything inside of the range. So the main difference between internal and external is, as you can see, anything outside of your range is external and everything inside of the range here is internal. Examples of an external, as you can see, this is your range. Everything outside of the range is your external. So let's talk about internal liquidity. What is the difference between internal liquidity and external liquidity? It's simple. It's in the name. Internal is inside of the range. External is outside of the range. So interior, exterior. You can see you have a swing high. That swing high is broken. And once price comes back in the range, now you can confirm your new range. And once you confirm your new range, understand that this entire area, this is where your internal liquidity will be at. And understand that the levels of your internal liquidity will be spread into 3. In all honesty, it's spread into 6, but we're trying to keep it simple so you guys can comprehend this lesson. So the first level will be your extreme. Your first extreme in this case would be your premium. So again, you really don't want to buy in premium unless the market is moving in a support and resistance. So price does have a possibility in reversing from this level. Now the second level will be anything in the middle, right? And your last level will be your extreme discount. So in this case, it will be cheaper to buy in discount and it will be a little bit more expensive to buy in premium. And fair price will be in the middle. So these are the 3 levels where your internal liquidity will be located at. So here's an example of internal and external liquidity. Price is bullish. Price break structure forms your internal liquidity, which in this case would be a bearish order block, an extreme bearish order block. It doesn't have to specifically be an order block. It can just be an extreme zone, which is the top half of your range, or it could be the top quarter of your range. Now price uses this level to continue now the bearish trend. But that was an example of your internal liquidity. So now you have the swing high that you're targeting. Price absorbs this level and comes back inside of the range to continue the bearish trend. Now this was an example of your external liquidity outside of the range. So now let's talk about the double swing external liquidity. As you can see, price rejected. What did price reject from? Price rejected from your resistance level. So price rejected from this level. And this is the last area where business was conducted and price was pushed to the downside. So above these 2 levels, above these 2 swings, this is where the stop losses would rest. So now we understand that price will be incentivized to absorb this level. So now once price attacks this level and takes it out, there's 1 or 2 things that can happen. Either price comes back inside of the range, forming your liquidity sweep, or price continues to the upside, forming your liquidity run. Now let's talk about another variation of external liquidity. And in this case, it's your failed supply/demand liquidity. And what makes this different compared to our previous double swing or even a triple swing is that the swings are not equal. So if you look at the previous example, the swings are equal. In this case, the swings will be kind of in a slope. As you can see, you have a swing, and this swing right here forms an extreme level. So in this case would be your extreme order block. And what happens here? Price approaches this level and rejects. But now if price does come back to that level and not continue the bearish trend, now we know that there is liquidity in that area. And why is there liquidity in that area? Because there's not enough sell orders to even push price down to continue the bearish trend. So 1, we understand the area is weaker. 2, we understand that this is where the stop losses of anybody that sold this move. So now price is incentivized to absorb this area. So now once price absorbs this area, it has 1 of 2 options. Either price comes back inside of the range or price continues for a liquidity run. So overlap liquidity, which would be your most powerful liquidity, is when you have your FTB and your classic external liquidity present. As you can see here, you have your classic liquidity, which is your double bottoms, and you have your FTB, which is a rejection of a demand zone and a failure. This is an example. As you can see, price rejected from the extreme demand, went on a micro bullish structure, came back down, rejected 1, 2. So you have 3 rejections, which is your classic external, and you have your FTB. So this is why this is a overlap liquidity. So now let's talk about liquidity sweep. So you have your external liquidity right here. And when price does reach for that level, price does not continue to the downside, similar to your liquidity run. Price comes back inside of the range, forming your liquidity sweep. So let's talk about what is a liquidity run. So you have a bullish trend and you have that swing low. This is what you're targeting as your liquidity. So this is external liquidity outside of your range. And what a liquidity run is where a price takes that level out and continues within that direction. Price does not come back inside of the range. So let's mark up all our levels of external liquidity. So previously we had this level right here and price ran through this level. So this was a liquidity run. There's a level right here. This was a liquidity run. So our next level is this level right here. We're strictly targeting external liquidity. And then we have another level right here. If you notice, both of these are FTBs. Not to confuse you, but just keep that in mind. So price accumulated here and went on a micro rally. So you have another level of liquidity right here. So what happened here? This was a liquidity run. Price did not retrace back inside of the range. Carry on. Both of these levels of liquidity, this was a liquidity run. Now, this is your level. Now price is forming a swing low. Now this is another level of liquidity. As you can see, price did not retrace back into its previous range. And you have another liquidity run where price broke down and did not retrace back inside of the range. So this is not a sweep. This is a liquidity run. And here you have a liquidity sweep. Why is it a liquidity sweep? Because price did not break through this level and continue to the downside. Price came down and came quickly back inside of the range, forming your liquidity sweep, aka your purge. So now let's talk about support and resistance structure. As you can see, price comes out of the range, forms your rejection zone, and retraces back. Now, the difference between your support and resistance structure and your supply and demand structure is when it's a supply and demand structure, price comes back inside of the range and retraces deep for a internal liquidity level. Now, when we're talking about support and resistance structure, price does not retrace deep inside of its previous range. Price usually rejects right at the top and expands again, forms another level of rejection, and retraces back to that level and expands again. So again, the difference is the retracement level. And when it comes to your support and resistance structure, when price does come out of the range, you can expect a liquidity run. Why? Because you have more room to work with, understanding that price does not have that urgency to return back inside of the range. So now let's talk about supply and demand structure. As you can see, you have a swing high. When price breaks that swing high, which is breaking out of your range, price usually comes back inside of the range. And this one makes it a supply and demand structure because price is always reaching for your extremes or at least your discount zone. And what happens here is when price breaks structure in a supply and demand structure, price does tend to go for a liquidity sweep instead of a run because price quickly needs to come back to your discount, or if it's a bearish trend, price needs to come back to your premium. Price will come back inside of the range and expand again, and then come back inside of the range, then expand again, and so on, so on. Take a look at this example. So as you can see here, price broke structure, retraced, did not retrace back inside of the range, break down. Retrace, now back inside of the range, and came back down. So what type of structure is this? This is a support and resistance structure. And again, even if price does, let's say, retrace, as long as it doesn't pass the 50%, which would mean that price is now going to the other extreme, as long as price does not cross the 50% line, this is still support and resistance structure. Now, if price reaches this level, now we can understand, okay, now price is reaching a supply level, which would be our premium level. And if price reaches all the way here, this will obviously be an extreme. So anything above the 50%, this will no longer be support and resistance. Just keep that in mind. So we have a rejection right here. So what can we anticipate now? We can anticipate another level of rejection right here. As you can see, price did not reach the 50% line. So the 50% would have been somewhere around here. As long as price does not reach this level, this is still a support and resistance structure. So let's carry on. And as you guys know, anybody that took my previous course, you guys know about our phases. So our P1, P2, and P3. So what happened here? Price formed a swing, retraced deep inside of the range, and broke down. So what type of structure is this? This is a supply and demand structure. So this is when structures change. And the reason this happens is because the market is not one way. If the market was one way, everybody would make money. So if the market just continued in a supply and demand structure all the time until a point where it's like, okay, now it's time to switch, and now it switches. And now it switches, then it would be easy to make money in the market, because then it's like, okay, price is continuing in a support and resistance structure. Then after a consecutive multiple swings, now price changes back to supply and demand. That's not how it works. Price can change pretty often, and you just seen a change here. You had your P1, P2 right here, then you instantly had a change to a supply and demand structure. So what is our range now? Price came back inside of the range. So we have this swing high, this swing low, and this swing high. And now we can anticipate price to retrace above the 50% line, right? So now we can anticipate price to retrace somewhere along the 50% line and then continue the bearish trend. As you can see, price retraced to the 50% line and broke down. And again, what you could guarantee is your move back down to discount, because price can always reverse from discount. So keep in mind, nothing is perfect and you're not looking for perfection. Price can always do what it wants to do. Nothing happens exactly every time 100% of the time. As you can see here, price is moving in a support and resistance structure. But it's not going to continue moving in a support and resistance structure until the end of times. Price will switch. And as I explained in ETM Concepts, you can see that price here starts to switch into a supply and demand structure. Price switches into a supply and demand structure. Now these big gaps are support and resistance. These gaps are support and resistance. So the market is in a support and resistance structure. So what happened? Just pull this out away from the chart. You can see that support and resistance, supply and demand, support and resistance, and your next phase could be support and resistance again, then supply and demand, then support and resistance, then supply and demand. So nothing carries on until the end of times. Price does switch back and forth between these two. And so let's take a look at this example. So looking at the macro, right? Without even switching timeframes, just by looking at price from this type of standpoint, what do you see? What you see here is that price made a swing and broke structure and then made a lower high. And even if you look prior to this, so if you look at price prior to this swing high is higher than this swing high, and this swing high is higher than this swing high. So common sense, obviously, we are looking at a bearish market on the macro. So now when you go on the micro, you can understand that the macro was moving in a supply and demand structure. Price was going to the extremes, rejecting. Price was going to the extreme, rejecting. Now price is at another extreme and rejecting. So now we can understand that the macro is bearish. And now let's look at the micro. Now the micro is bearish too. As you can see here, you have the exact same setup. And this is what I teach in our ETM concepts. When everything looks the same on your macro and your micro, this is when you're supposed to take a trade. Nothing else. We only look at the highest probability trades. So now that you have the same market replicated on the micro as in the macro, and the direction is the same, the market profile is the same, literally everything is the same. So let's say you're targeting this swing. You're targeting this external level. If price gets up to this level, right? So let's say price attacks this level of liquidity. Are you expecting a liquidity run or are you expecting a liquidity sweep? And the answer is you're expecting a liquidity sweep. Why are you expecting a liquidity sweep? Because like we said, the macro is bearish. The micro is bearish. And the external setup right here, price has no reason to get up this level unless it wants to sweep. Again, anything can happen. This is the market. Nothing is guaranteed in the market. But probability wise, if price does get above this level, price will more than likely come back inside of the range. You can see price took out this level, formed your liquidity sweep, which is your purge. And now you can expect price to continue up to a point. You can expect price to continue to this level of extreme as your first target. So this will be our first target. So we're going internal. That's obviously our first target, just how I explained in the concepts. So internal to internal is our first target. And our second target would be the external liquidity here. Is obviously below this swing right here. And it's the bottom of the range anyway, so it's common sense. So price reached the extreme level. And this is why I say the first TP should always be your internal. Should always be your extreme internal. Because look at this reaction. Look at how price reacted from this level and shot up. And again, price could come up here, react of this level, come down. Price could stop hunting this level and come down again. But you'll be waiting in a trade for a long time. And again, when you're on a simulator, you don't take into account the time that you spent. But in a real trade, you always want to take your profits in your first TP because you don't want to wait for a trade. A lot of people psychologically can't handle waiting for a trade that long. So let's carry on. And this is why I say that first exit should always be the internal. Price rejected from an internal. So now from an internal to an internal, even if you're trading this position, it should be internal to internal right here. If this is a new entry, if you're still holding on the first entry, then obviously your exit is right here. As you can see, price stop hunted, rejected off this level and stop hunted these levels again. So price took out this level, stop hunted this level. Like we said previously, price has no reason to come above this level unless it's a sweep. And now price went to an internal. So now, as you've seen here, you had a reaction. Same thing that happened previously. And this is what I say about timeframes. The exact same thing happened previously. What happened in the previous example happened here again. Price rejected from the extreme. So now let's talk about clean traffic. So as you can see, you have your swing low. And let's say in this case, we're targeting this swing low for external liquidity. Now price approaches this level, but rejects. So now what you need to do is understand why price rejected. Price rejected because of internal liquidity. So now that you know that price rejected from that internal liquidity, either or, price did form another swing. So that swing now is another external liquidity target or absorption. So now where's your clean traffic? Your clean traffic is in between both of these external points. So now when price does target that first swing, price will more than likely target the second swing too. And this is where you have your clean traffic. So now let's add more context to our clean traffic, and we're going to look at it from our bullish scenario perspective. So here you have your swing low that you're targeting for an external sweep. So price approaches this level and rejects. So we obviously know that this is a result of our internal liquidity. And now we have another swing that we're targeting for external liquidity. So now we know if price does approach the first swing, price will more than likely absorb the second swing as well. Why? Because it's clean traffic. But understand, this is a bullish scenario. Prior to this, price was bullish. So what are we looking for? A liquidity run, or are we looking for a liquidity sweep? In this case, since it's a bullish scenario, we're looking for a liquidity sweep. Price will absorb both of these levels and come back inside of the macro range to continue the bullish trend. Now, let's look at it from this point of view. Price is in a bullish trend, and you're targeting this swing for your external liquidity. Price approaches the level and rejects. And we know that's because of our internal liquidity. So now we have the second swing to target. So if price approaches the first swing, we can obviously expect the second swing to be absorbed as well. But what are we looking for now? Are we looking for a sweep, or are we looking for a liquidity grab? A sweep, or are we looking for a liquidity run? In this case, since it's a bullish trend, we're looking for a liquidity run. So let's talk about clean traffic. As you can see, this is clearly a bullish trend. So price wanted to target this level of liquidity, but instead, price rejected from this level instead of targeting this level. So why did price reverse from this level? Price rejected from this bearish order block. And this bearish order block is obviously in your extreme zone. So instead of targeting this level of liquidity, price rejected from this level. So now you have two levels of liquidity to target. This is another swing. So now we know that if price does absorb this level of liquidity, price will more than likely absorb this level of liquidity as well. Why? Because this is clean traffic. If price absorbs this level, price will more than likely absorb this level. This zone is where you have the cleanest traffic. So now what happened? Price absorbed this level, and price was forced to absorb the second level. So even though we're in a bullish trend, it's not guaranteed that, let's say, it's not guaranteed that price would absorb this level of liquidity and continue on the bull trend. Why? Because clean traffic does not determine the entire direction. That's simply not enough. Now, the probabilities are in your favor, but what we simply have the highest percentage of is from price going from this area to this area. This is where the highest probability is. Now, again, a lot of times price does take out one level. Say this is your level and your next level is this level. A lot of times price does take this level, then instantly goes for this level and continues the trend to the upside, but that's not guaranteed. The highest probability is in this level, in this clean traffic level. Now, as you can see, once price took out the first liquidity and absorbed the second liquidity, price retraced. So what do we know now? Price absorbed the external liquidity. So what is price looking for now? Price is more than likely looking for internal liquidity. So you pull out your fib. And you can anticipate price to reach for this area for an extreme demand. And to continue to the upside if there is enough volume in this internal liquidity. So again, the guaranteed run is your clean traffic from this area to this area, just like what happened in the first interaction. Now, what happens after that, price could always retrace for internal liquidity. So you can't just guarantee this entire run based off price absorbing this level. So let's take a look at this example. So what do we have here? We have a swing high, swing low, and what happened here? Price rejected from an extreme level. So this area where price rejected from is your clean traffic. So you mark this area and you understand that once price gets up to this area, it wouldn't just take one level of liquidity, it will more than likely take the second level too. That's why we call it the clean zone. So what do we have now? And I'm not going to pull out the fib every single example, but let's just do it in the early stages. So you have a rejection right here. So what is your clean traffic? Your clean traffic is from here all the way to here. This is your clean traffic. The zone with the least resistance. That's all it is. Price almost closes out the entire zone, but not all the way, but it's still closed 85% of the zone. Now the zone is already used up. What do we have here? Price rejected from an extreme. So the bottom of this swing, which would be your first level, all the way to the end. And why are we marking it like this? Because obviously why are we marking it like this? Because obviously you have this level of liquidity and you have this level of liquidity. So instead of marking both levels, we're just going to mark it as an entire zone because it is clean traffic. And price took out both levels. You can see how smooth this transition was. Even here, you can see that price did not consolidate a lot around this area. Why? Because there's not that much rejection in this area. Price is eager to grab liquidity. You have a rejection here from an extreme. Now we mark this area, this swing low, and this swing low. Now this is our zone. And price grabbed the entire zone, covered 100% of our zone. Let's carry on. What else? We have this zone right here. Price rejected from an extreme of its swing. So this swing low, this swing high and this swing high. Now this is our clear traffic. And you also have another level right here with this swing and this swing, but we're just going to target the major swings right now. And price clearly took out 100% of that zone. Now let's carry on. What do you have here? Now we got to measure this. Okay, not yet. But what you do have here is an extreme rejection from the bottom. So now we have this clear traffic zone right here. And how you can use these to your advantage would be mainly scalpers. If you're a scalper and you can get on a lower time frame, so currently we're on the 1 hour time frame, and if you're on the 1 minute time frame, this is a huge area. Why? Because you can have a lot of swings. You can have multiple swings on your 1 minute. Let's stretch this zone out. We missed the level, which was this level of rejection. Price did fail the first time, but second time came and cleared out the entire level. Okay, price easily covered this entire zone. And easily covered this entire zone. So you can see why these levels are powerful, because price smoothly takes out these levels. So when looking for clean traffic, looking at the trend is simply not enough. You need greater context. And in this case, the greater context will be your macro time frame, which will be your higher time frame. So in this example, your higher time frame will be in red and your lower time frame will be in black. So this is our higher time frame. We have a swing. Now we have another swing, and that swing was a lower high. That lower high produced an extreme area, which in this case would be your extreme supply. And it could also be just simply the extreme area of the range. But now when you go on a lower time frame, you will see a bullish trend. Price making higher highs, higher lows, higher highs, higher lows. So when you have a bullish structure, when you're targeting a swing low, you're looking for a sweep. When you're targeting a swing high, you are looking for a liquidity run. So let's keep that in mind. As you can see, price wants to approach that external level, which is your swing high, but rejects. And why does price reject? Price rejects because of an extreme level. Price rejected because of this extreme supply. So now you have two levels of external liquidity. Be this swing and this swing. And we understand if price approaches the first swing, this second swing is more than likely. Why? Because this is your clean traffic. And since this is a bullish trend, a lot of traders will think that you can go on a liquidity run. They would not expect a sweep, and their buy orders would be right above. But the only problem is, look at the higher context. You have an extreme macro level of supply. So if price does touches that area, price can more than likely reject to the bearish side. Price breaks that level, absorbs both of the levels, and comes back inside of the range and reverses, forms a swing. So again, even though the trend is bullish, price can still sweep a swing high. That's why macro context is extremely important. So let's talk about the highest probability liquidity run. So first thing you want to do is you want to stack up the odds in your favor. You want to stack up the probability in your favor because trading is a game of probability. So obviously first thing you would do is you want to make sure you have your sweep or run bias set via trend. So let's say this is a bearish trend, just as we can see here. If you're looking for a break to your swing low, which is your bearish side, probabilities would say that you're more than likely to get a liquidity run. Why? Because it's a bearish trend and you're more than likely going to continue the trend to the downside. Now, if you're targeting your swing high right here, the probability is either price completely changes character or price goes for a sweep. So the probability here would go for a sweep. So in this case, if we're targeting a high probability liquidity run, we're going to target this low, right? We're going to target this. We're going to target this low. But we know that this is simply not enough. We need to add more context. So now you look to your left. So now you look to what happened previously. Start building your story. What happened prior? Price had a previous range. Price broke structure here, and which was obviously this was the previous range, and price broke structure and came back inside of the range. So what does this tell us? This tells us that price grabbed external liquidity and went back inside to grab internal liquidity. So what can we anticipate now? We can anticipate now price reacting from the internal liquidity to now reach external liquidity, or at least reach extreme internal liquidity. Let's keep that in mind. So is that enough? Not yet. We still need more context. So let's wait for more context. So what do you have here? Like we said, either price is going to use the internal to grab for external liquidity, or price is going to use the internal liquidity to be matched with internal liquidity. So now we mark up our internal liquidity. Price rejected from this extreme. And this was our extreme what? This was our extreme demand. So now what do we have here? We have clean traffic now. So now from this level to this level now, this is our clean traffic. So now we have our clean traffic. So now if price gets below this level, we'll more than likely target this level. So now what are the clues? Our first clue is our trend. Our second clue is price breaking structure through the previous range and returning back inside of the range to grab more internal liquidity and continuing the downtrend. Our third clue is this clean traffic being formed, price rejecting from an extreme demand. And what would be our fourth clue? Our fourth clue would be if price targets this level. Price targets this level, you have a high probability of price grabbing this liquidity as well. And now if price grab both of these liquidity, this is where you have the highest percentage. This is the highest liquidity run percentage. And price could also continue lower because you're going back to the trend concept, the fact that the trend is in your favor. And this is how you reach the conclusion of having the highest probability of a liquidity run. As you can see, once price reached this level, price instantly targeted the second level, and since it's a downtrend, price continuing to the bearish side. And not only that this was a high probability liquidity run, this was high quality clean traffic. Why? Because you not only had one rejection, as you can see, price not only rejected from this extreme. So let me erase this. Price not only rejected of this extreme once, right? So what happened here is there were buy orders here. These buy orders were used for this move. So now this move is vindicated. Now price came back again. So when price came back again, price tested this level one more time. And we know every time price taps an area, this area loses strength. So there's less and less buy orders. And not only that, this area formed its own extreme demand level that's been used as well, and price never got below the initial point. So as you can see, price here never got below to the initial point. And to draw it up, you can see that price rejected once, came back, formed its own low, rejected second time, third time, and broke structure and then dropped. So let's take this out. So the first rejection was right here. Now this rejection here formed another rejection here. And as you can see, these two swings never got below this first interaction. And then what happened here is price broke structure to give you a fake sign of strength, to trying to induce traders into taking a buy position by taking a breakout trade right here. So by inducing traders into taking a buy trade right here above the breakout, and to take a retracement return to origin order block trade right here. So there's two fake outs. So this is why this is the highest probability liquidity run. So let's talk about inducement. As you can see, you have a swing, and that swing forms your point of interest. This swing forms your POI. So now this POI, let's say in this case, is an extreme supply, or you can say an order block, or even you can say a shelf bottom or a fair value gap, either or. So you're targeting this level, and this is the level the institution intended. But price approaches this level and rejects prior to that level. So now you have another swing. So what does that swing do to the average trader? It throws them off. It makes them think, okay, now this swing forms another quote unquote point of interest. So now they're targeting this level. But us informed traders, we're not targeting this level because we understand that we're still focused on the main point of interest. And we understand that this is just a divergence. So now we are targeting this swing. So now price will take out that fake point of interest, absorb the liquidity, and sweep. So let's look at the basics of an inducement. So as you can see here, you have your point of interest right here. Here you have your liquidity being engineered. This is your inducement. Why is it inducement? Because price rejects from an area and insinuates that price wants to continue higher. As you can see, price even gave you a micro swing high to the upside. So price wants to induce traders into taking a higher position. So it's simply like this. Let's say you have a swing, price breaks this level, comes back and rejects an even break structure. So what does that tell retail traders? They're like, okay, now price is going to continue to the upside. So when price, even if price does retrace, they're looking for a demand level right here. And this is specifically a lot of smart money traders. They would think that, okay, now I can take an order block entry right here just for price to take them out, use this level as liquidity and go to the initial point of interest and go to the direction they initially intended. So again, this was your point of interest. This is your liquidity right here. Draw it better. This is your liquidity. Price came down, took the liquidity and continued to the upside. So again, everybody that purchased price right here or even purchased price right here, they lost the trade, especially the people that took the secondhand entry. And why did they take the secondhand entry? Because first they had a break of structure to the upside. Once they had that break of structure, they took the retracement right here. This was the trap. A lot of smart money traders bought into here just for price to do what? And if you really want to break it down even more, they took this bullish order block right here on the lower time frame. So obviously, if this is the 2-hour time frame, on the 15-minute time frame, you will see even a clear order block. And not only that, what happened is they got met with supply force. So there were sell orders right here. As you can see, price did reject from an internal base. So the sell orders here overpowered the buy orders, pushed price back down. You had your stop hunt right here. You had your liquidity sweep. Price trapped all the sellers and continued to the upside. So let's look at another example. Okay, so here you have another example. Price rejected from this area and formed a bullish order block. So now what happened? Price rejected from this level and broke structure as well. So once price broke structure, now you have a lot of smart money traders. Okay, now it's time to get in a buy. And what did price do? Price came back to that order block. Let's zoom in. So what happened here? Price broke structure. Once price broke structure, price retraced back to this order block, as you can see, but failed to break above this level. So what does that tell us? That there are more sell orders than buy orders. And let's go back to our first lesson in this free course, is that now price needs to go back and grab liquidity. So now price comes back down, grabs liquidity, traps the sellers, uses our order block right here, which would be our extreme demand level, and give you this entire move. Now price has enough buying force to expand. And now let's look at this example. Price broke structure, came back down, rejected from this level, gave you a few micro swings, which is in form of compression. So now you're thinking price is going to continue up. People are trying to buy price right here. Anybody that tried to purchase price right here lost the trade. Price came back down to the extreme of the range. So now you pick out your last low and your high, and you mark this entire area. This is now your extreme demand zone. Price came to the extreme demand zone and expanded. So now where was your liquidity? Your liquidity was this entire area. This was your external liquidity, and this was your internal liquidity. Everybody got induced into taking an early trade. Price went to the initial mark and now gained enough buy orders. So here you have your break of structure, and here you have your extreme zone. So let's say this is your extreme zone. This is what you're targeting as your point of interest. So as you can see, price rejected, but price did not interact with our extreme zone. So what do you do next? First, you want to make sure price comes back inside of the range. Okay, so now you have this high. So now this is your high and this is your low. So you pull out your fib, and you can see this is your extreme zone, right? This is your point of interest. This is your extreme discount. So what do? You understand that, look at inducement. The inducement here, this was a fake out. This is trying to force traders into taking a early buy position, even though we know that the initial buy position is here. This is where the highest probability is. But the market wants to induce you into taking a early position. You can see price rejected from fair price. And like I always say, you want the inducement to be in or around the fair price. You want to make sure your inducement does not interact with your extreme. So let's say price comes down here and reacts off this level and comes up here and then comes down here, you will more than likely get clean traffic and get a liquidity run instead of getting a sweep. Why? Because obviously this is clean traffic. So you always want your inducement to be around the fair price and make sure it does not interact with your extreme. So now you can see, what did price do? Price broke structure, reacted of these low, fake stop hunted, and expanded again. This is trying to induce traders into taking early buy positions. You can tell that you'll have retail traders purchase price here, and now that there's another retracement, they will purchase price here. So this is the fake out. So what can you expect? You can expect a liquidity sweep right here for price to fake out this level, sweep, and interact with your point of interest to continue the bullish trend. And you might even get a fake reaction right here. By fake reaction, I mean a false signal. So you can get something like this. This is a false signal. This is just another attempt to engineer liquidity. As you can see, price is reacting off this level. See, price is reacting off this level. Can't make this up. Now buyers are coming in. Okay, now price is going to continue to the uptrend. You have more buyers and more buyers. You have buyers right in this area. Price rejecting. Now you have more buyers up here. People think that now you're going to have a bullish trend. Just for price to go to your initial point of interest. And stop hunt. Now you have your stop hunt. All the sellers been trapped. Because again, not only buy orders were coming in here, once they seen this failure, you have sellers coming in. So now you have sellers coming in. So you have sellers right here. Okay, now price is going to continue to the downside. Now they're looking to sell this position. So when an inducement happens, both buyers and sellers get trapped. But in reality, we knew that this was simply an inducement. So for a basic overview, what you need to understand is price will move within internal to external points, and understand that price does need liquidity to move. So price does not move in a straight row. Price doesn't just move like this. Price moves, break structure, comes back inside, break structure, grabs external, break structure again, and so on. So this is how price moves. So keep that in mind. Price doesn't just move in a straight line, then it'll be simple, right? So as you can see here, price is rejecting from this level. Now either price breaks this level or comes back to look for more liquidity, looks for more internal liquidity. Price reaches for internal liquidity, then breaks structure for external liquidity. So now price broke external liquidity. So now either price retraces back inside of the range to look for more internal liquidity or goes on a mild run. Price reaches for internal liquidity. Now you have a sweep. So now price reached for this sweep. So now you have external liquidity. So now either price reverses and continues the bullish trend, which is more than likely, or price breaks down and aims for this level. So price reached for this level. So now you have your range. So now either price continues or price retraces for internal liquidity. Price tried to retrace, but rejected at the support. So you have a rejection right here, and you have external liquidity right here. Price grabs external liquidity, and grabs another level of external liquidity. So it's always price going from internal to external, or internal to internal, or external to external. So understand that price doesn't just move in a straight line. Price will always pull back and grab more liquidity. Thing you want to do is you want to grab context, and as you can see here, you have a swing low, swing high, rejection back at an extreme. So if you continue this macro structure, you would expect an expansion all the way until an extreme level. So first thing, let's mark up our extreme level. So in this case, this will be our danger zone. Obviously, we expect a complete break of structure. So we are expecting the trend to continue to the upside. But just in case, we always mark the internal liquidity, because price can always find rejection in extreme levels. So we have this level, and this is one of our targets. The next swing that I see, that's a major swing right here. Why? Because look at the reaction from this swing. Always look at the reactions. You can see the reaction from this swing was rapid. Price quickly sold off. So we can assure that there were a lot of sell orders right here. So if they sold here, where would the stop losses be? Either right above here or right above this external level right here. Is right above our level. So now let's look at our micro structure. So what do we have? If we simply ignore everything that we know prior, obviously we know that there is a rejection here at an extreme level of a macro, and we can expect price to target this level. So we understand that. Now let's focus on our micro. What is price doing right now? Price broke structure and came back inside of the range, forming a sweep. So we have our external sweep right here, and the seller's been trapped. Now you pull out your fib again and start looking for your levels. So price could reverse from the premium right here, from the discount right here in this case, which price already kind of did. So if this was the level, price already rejected from this level once, twice, and you can see price is making higher highs, so it's building. So we can disregard this level and understand that now price could be reaching for this level, which is an order block right at fair price. And if price breaks through this level, price could be reaching for this level. So we are anticipating something like this. Let me mark our levels. So now that we had an external swing on a micro range, we can expect now price to target internal liquidity, since price failed the first level of internal liquidity. So now price can target this level. Either price rejects from this level, and now if price breaks through this level, now we can target this level right here. If price breaks through this level, now we can target external liquidity. And if price breaks through this level, we can target this level. We have our bias up to here, and then the price starts making higher highs right here, then we can target our extreme external macro level, which is our higher time frame macro, as we explained previously. So this is the road. So now let's see how price behaves. So now price targeted the first level. Let's see now if price breaks this level. As you can see, price is finding rejection right here. Now, what can happen right here? What could happen right here? You can see price is rejecting from this base. If price breaks through this base, now we're looking for simple clean traffic, which in this case would be right here. This would be our clean traffic. If once price enters the zone, you can expect price to absorb the entire zone. As you can see, once price reached this level, it absorbed the entire zone. So now we have an external. So now we can go right back into another internal level. So now price could be reaching for this level. We don't need to pull the fib. Obviously, we know that this is the level of extreme. So now price is either targeting this level, and if price breaks this level, it will target the external, and we're aiming for this micro range. The price is finding rejection at our extreme, just how we anticipated. It's made a low. If price makes a high, then we can anticipate a reversal. Price rejected from your return to origin and now made a higher high. So now that we have this rejection, we can say this is clean traffic. And once price gets in this zone, it will absorb this zone as well. And now we can say price is going to target this level. So this is where you have your clean range all the way from here to this level. Now, once price reach this level, we can now assure that this level will be targeted, and from here all the way to here is also clean traffic because there's nothing else. And if you look to the left, you have an empty volume gap. So price is rejecting from the extreme again. So what are we looking at? If price makes a sequence of higher highs, now we can target the external, or price breaks the low and targets this level, either rejects or absorbs and goes for an external range. So we would look for a return to origin or clean traffic. And once price broke this swing low, price instantly targeted this level. So what are we looking for now? We're looking for the last swing low prior to the last swing high. So you had this swing high right here. This is your lowest swing low. So this would be your major liquidity. So now this would be your major liquidity. And do we have any clean traffic right here? We have a rejection right here. So if price does absorb this level of liquidity, price absorbs this level of liquidity, price will more than likely target the second level as well. Price is now making higher highs. So where would the rejection be as far as higher highs? Would be in this base as an extreme. Once price approached this level, went for a quick pullback to target, to grab more sell orders to target the external level. So now that price took out this level, this is the nearest high, and now this is your extreme. So either price goes up to this level and rejects, or price goes up to this level and breaks above. And once price breaks above, you have your clean traffic right here. The entire area would be now your clean traffic. And if you feel confused, you can always rewind. You could always rewind, or as you go forward in this course, you will learn more. So if price does absorb this level, you can expect now price to continue target this level and potentially now target this level that we had mapped out previously. Let's speed this up. Okay, what do we have here? Price tried to reject from this level once, failed, and now went deep inside. So now what are we targeting? We are targeting now this swing right here. And once price absorbs this swing, like I said previously, we have our clean traffic. So you can expect an easy ride up to here. Price is finding rejection. And now price grabbed external liquidity to grab this level. So now we are targeting this level. And this is where our clean traffic, and as you can see, price quickly accelerated within this level. Why? Because this is clean traffic. There's no rejection here. And now price targeted this level. So now what is our next level we're targeting? This level right here. Let's speed this up. Price retraced. What is price looking for? Either price is going to reject from an extreme right here or target the liquidity. And where would our rejection be right here? Since we're done with this clean traffic, our rejection would be our extreme right here. So this would be the next level price is targeting. And when I mean that price is targeting this level, it's not that we're anticipating a reversal or so. We're using this level as a magnet. We're anticipating that price will be attracted to this level. You can see price was attracted to this level. Now price rejected. So now that price rejected, you have clean traffic right here. What does that mean? That means if price reaches for one level, price will reach for the second level. So if price takes out this swing right here, price will more than likely take out the second swing as well. And instantly, once price took out the first level, price took out the second level. Now we have a rejection right here. So let's talk about high quality liquidity pools. So first thing you want to mark up is what price is doing currently. So price currently broke structure in a, what it seems, a micro bullish trend. So now let's look at the macro, and you really don't have to change time frames. You can always just zoom out and kind of get a picture of what price was doing prior to this. So you can see that price previously rejected from an extreme. And you can see right here, price rejected from an extreme. So what are the scenarios? And this is one of the trickiest parts. Why? Because you can see the price is trapped. So now either price rejects from this level, or price rejects from this level and drops down, or price completely drops to this level somewhere on fair price and attacks this level again, eventually breaking that level. So this is the hardest scenario to be in. But the purpose of me showing you this is that you need to always look at the immediate and try to read the market based on a move by move sequence. So you have this level. What liquidity could the market be targeting? You can see here, price rejected from this level. Price rejected from this level. So now you have clean traffic right here. So let's mark up our clean traffic. You have clean price could be targeting this clean traffic right here. Also, price could also reverse back inside of the range. So price reverses back inside of the range. You can start looking at your levels and obviously start off with your internal liquidity and build your way to external liquidity. So now price retrace back in the range. So what you want to do is you want to pull out your fib and start locating your levels. So this is fair price. This could be your first rejection. What do you have here? You have your breaker. This could be the first level of rejection. You also have a fair value gap right here that's kind of overlapping with your breaker, so we're not going to count that. And you have your extreme zone right here. So these are the levels price could be targeting. Price rejected exactly from our extreme and went for external liquidity, right? So now that we know the price took external liquidity, what are the levels? So let's go back one candle. So now that you've seen this, what could happen next? You always want to look at the immediate. So first thing is you have your clean traffic. You have this rejection all the way up to here. This is your clean traffic. So let's just make it yellow to kind of continue with the theme of this course. So this is your clean traffic. And now you had an external. So if you had an external hunt, what is the next step? Now you're looking for either internal or external liquidity. And pulling out your fib again to the nearest swing. Price rejected now from fair price. So this could be your first level the price is targeting now, price could be targeting this level as well. And you can see that there's an order block here. So price could simply just be targeting this order block. And the purpose of doing this, you're kind of mapping out where price wants to head. So price reached this level. And now either price rejects from this level and targets this liquidity. And if you don't see a significant rejection, you start seeing higher highs, then you can say that now price is targeting this level right here. Why this level? Because you have clean traffic right above. See a lower high being made. And now a higher high being made. So now you can say now price is targeting this level. So now you have free range in this entire area. And price now targeted this level. So let's carry on. So what do you have here? You have your range. You have your extreme right here at the bottom, and you have your previous rejection here, which would be your breaker. So price took out external. So now price is looking for internal. So you could say that now price is heading down to this level, which it kind of already did. Not really, but almost did, or price will head to the next level. Now, if price breaks another high, you can now say that price is targeting this level right here, your external liquidity. Price went down to our extreme demand. Now, if we get a sign of a higher high, we can target our external liquidity or our internal extreme. But the thing here is, since it's a uptrend and you can see that price did already reject from an extreme, you have your clean traffic here, which will more than likely result in price targeting the second liquidity. What do we know now? We know price is targeting this level. This is simply inducement.